Okay, good morning everyone and welcome to our webinar today on the corporate income tax implementation in the UAE. I hope everybody can hear me clearly and thank you again for joining us, and especially for those who attended earlier. The webinar is scheduled for 1 hour and I'm sure you are all busy, so we'll do our best to stick to 1 hour. We will have hopefully by the end of the materials, the questions and answer sessions. Hopefully we'll get your questions and answer it whether during the session, during the questions and answers, or later on. This is Yasser Atiyyeh and I will be your presenter today, joined with my colleague Zuhaib, who will be also collecting and gathering questions and comments that you might post on the chats, whether during the course of the session or at the questions and answer sessions as well. Just a quick housekeeping items. Please note that for the purpose of maintaining security and privacy, all attendees are automatically muted and cameras are disabled. However, if you have any questions during the webinar, please do feel free to add them to the chat bottoms, or you can raise your hand during the questions and answer, and we will be glad to answer you, or will enable your camera or microphone. We will have, as I said, questions and answer session at the end of the webinar, and in case we run out of time, we will do our best to get back to you separately. The webinar, as you must have seen, the message is being recorded, and the recording together with the materials, slides used in this webinar will be distributed to all attendees and registered attendees within a couple of days. So hopefully you don't need to take screenshots or notes during the sessions. All what we hope that you will focus on the materials, and if you have any question that you can raise your hand or ask. We will have a couple of polling questions, just polls questions. We'll really appreciate your feedback on that. These are just really to understand your background and experience, as we will discuss later during the course of the session. Also, please note that we will have the same Arabic webinar this coming Thursday at the same time, and you of course welcome to attend if you wish, or if you are an Arabic speaker. Okay, so moving to the agenda and the objectives. I hope and trust the objectives of our webinar today will add value to all of you through achieving the following two important objectives. The first one is, of course, to learn about what is the corporate income tax in UAE and how it will impact you or your business or your company. And this is really important, as we have seen or read or heard from the ministry or from the FTA, who will be managing the corporate income tax in UAE, or the other organization who is conducting a research in UAE, is one of the most challenging items in terms of implementing corporate income tax in UAE or direct tax, is in fact the capabilities and resources and experience within the finance and accounting professionals. So hopefully this is one of the items that, or one of the sessions that will help you develop your knowledge and experience in terms of corporate income tax in the UAE. And the second one is, of course, once you learn what is corporate income tax, we'll go through the questions and answer as published or explained by the Ministry of Finance and the FTA. What is the action plan? What is the roadmap? What is the next step that needs to be done? This is as an introduction session or a webinar, is really talking about some basics, answering some basic questions, giving you some knowledge about the corporate income tax and direct taxation that will be implemented in the UAE. But we will have some further and following webinars in the near future that we will address and discuss in more advanced details the corporate income tax and its implementation. For the agenda, in order to achieve our objectives, we'll talk about the introduction, of course, and background and overview of the corporate income tax definitions. Really, we'll talk about the scope and rate applicable, special scopes when it comes to certain jurisdictions, as will be addressed within the regulations that are expected to come soon. The registration when it comes to corporate income tax groups, the tax treatment, which is important for tax planning and policies in certain specific areas, as we will see, and important areas for considerations. Once you learn what is the corporate income tax, what will be really the impact, and how you should address this within your business. And hopefully we'll have the chance to talk about how we can help if there is any need. So, although I appreciate the corporate income tax introduction in the UAE as announced by the Ministry of Finance just less than a couple of months ago, exactly on, I think, January 31st of this year, might have come as a surprise to many people and businesses. However, I believe that those were actually really expected within the development of the recent regulations, as you must have experience, starting with the value-added tax, the indirect taxations through VAT, and then in 2019, the development of the economic substance regulation, ESR, followed by or through the anti-money laundering, the AML implementations and compliance and related compliance, which was really all driven or impacted by the UAE being a signer or part of the OECD, which is the Organization for Economic Cooperation Developments. We'll discuss this, and we'll talk about what is the OECD in further details, as I'm sure you will hear more about it going forward. So the corporate, then of course, the recent announcement of the corporate income tax implementations, which will take effect from June 1st, 2023 of this year. I do hear sometimes people saying it's still too early, but trust me, based on my experience, it's never too early to start planning the implementations and the readiness and the assessment for the corporate income tax in the UAE. So moving into the overview and definitions. So what is the corporate income tax as defined by the ministry and the FTA, and as is known as part of the direct tax that is levied on the net income of or profit of the corporations and other businesses. And this is really a direct tax that is calculated or imposed on the net accounting profit as defined as will be defined by the regulation and as answered by the ministry. I often hear the belief or the think that it is as simple as the tax rate, which will be 9% times your net profit. And I can tell you honestly, based on my experience, it is not that straightforward. And most of these businesses who really think it's that straightforward, just taking your net profit and multiply it by the tax rate, often end up overpaying for their corporate income tax or direct tax than what they should be. So the corporate income tax will be a federal tax. It's applicable to all emirates, all jurisdictions, all businesses, even the free zone entities, as we will see later on, with certain conditions, and will be managed by the Federal Tax Authority and the FTA. It is highly likely that the tax registration that you might have now under the VAT will combine both the corporate income tax and the indirect tax or the VAT. Just quickly to an overview of what is the difference, what is the corporate income tax as part of or being a direct income tax in comparison to what we have now in the UAE as VAT, the value added tax, which is an indirect tax as we know. So the corporate income tax is what we call the direct tax. It is paid and incurred by the business itself versus the indirect tax, which is ultimately, as you know, incurred or carried by the consumer or the end consumer. So the direct income tax is really an expense to the business. Versus the indirect tax or the VAT is usually receivables or payables, provided certain condition that is related to a taxable supply. The income tax is actually an expense that will be taken out of your net profit and will, before posting any dividends or posting your revenue or net profit to your retained earnings, for example. Um, so, and in both cases, you will have credits, as we will talk about later. There are credits that you will be able to deduct in your tax return. When you file the tax return, there will usually be adjustment or deductions after you calculate the direct tax. Versus the indirect tax or VAT, it is usually netted off between inputs and outputs. So it's receivables or payable position, although you might have some credit, but it's not directly impacting, what you will end up paying. A quick comparison in terms of the tax rate that we will be applicable in UAE, which is, as you must have heard, it's going to be 9%, which is still whether within the GCC countries, within the Gulf region, or globally, is actually still lower than most of the jurisdictions as 9%. And this is a quick table in terms of comparison between the GCC countries when it comes to VAT rate and the corporate income tax rate. Of course, for KSA, there is also zakah, as you must maybe aware. As we can see, the Kuwait and Qatar is still to implement the value-added tax in accordance with the GCC treaty, which is, I expect it will be, as we hear, within the next 1 to 2 years. And in terms of corporate income tax, probably Bahrain is still the only country that has not been implemented in, but most likely it will be implemented soon, as we hear also. So globally, the UAE is still within, the lowest tax rates jurisdictions, really. So just going through the certain definitions and overview in terms of the effective date of the regulations or the effective date of the tax implementations in UAE. As we all hear, it's going to be effective from 1st June to 2023 of next year. How would this impact your financial year? For most of the financial year, I will see, as we will see through the following examples. For a typical calendar year, that is January to December, the first tax year will be from January 1st, 2024 to 31st December 2024. So it's going to be effective for these calendar years entities for January to December 2024, although it will be effective, the regulations or the cutoff date from June 1st, 2023. For those entities that have starting financial year of 1st July, it will be effective from the 1st July 2023 to 30th June 2024. Obviously, because their year beginning after June 1st, their June 1st, 2023. For those entities who have 31st May year end, their first year, their first financial year or tax year will be from 1st June 2023 to 31st May 2024. And for those businesses who have 30th September financial year, their first year will be 1st October 2023 through 30th September 2024. Now, these are obviously for the first or initial tax periods for businesses in the UAE. However, regardless when is the first tax year, I think it is important to, as we will discuss during the sessions, it's important that you consider the tax planning and tax policies prior to the effective date of the regulation, which is June 1st, 2023. The due date for filing the first corporate income tax return it should be addressed within the regulations. It still have not been addressed or confirmed by the ministry or the FTA. However, usually in most of the jurisdictions, it is within 3 months period following the end of the tax year. So probably we're talking about, for those calendar years, let's say that will end 31st December 2024, most likely the tax return will be within March of 2025 as a first tax return to be filed. In terms of scope, the corporate income tax will be applicable on all businesses and commercial activities that have a legal status or incorporated in the UAE, whether free zone jurisdictions or mainland. It will be subject to registration and tax filing. How do you determine the legal entity has a business as a business? That will be within the scope of UAE. All activities also that will be based on effectively the license. Any business have a license, or individual or sole proprietor, or a business that have a license should be considered as a corporate for a corporate tax for corporate income tax purpose. The activities that are undertaken by a legal entity that will be deemed as a business activities and hence within the jurisdictions or within the effect of the regulations. Now, how do you determine whether individual has a business that will be within the scope of UAE? As we said, it will be based on the business license. Any business license will be considered as a legal entity for the purpose of the corporate income tax. How do you determine the business profit or income? As explained by the ministry, it is going to be based on the accounting net profit in accordance with the generally accepted accounting principle, which we know here in the UAE, as per the company's law, it is the IFRS. So your net profit or net loss, that will be determined in terms of the first item on the tax return. It is important to note, though, that the lack of appropriate and sufficient accounting records and financial statements would usually result in an assessment by the tax authority, or in this case, the FTA, and therefore it is highly likely, in case of there is an assessment, that the tax will not be really based on the net profit, but based on the tax assessment, which obviously any taxpayer should try to avoid. So as this, we said, as this will be based on the IFRS books. So for really small businesses who have no accounting records, no financial statement, this is really important for them to consider that, maintaining accounts, maintaining appropriate accounting records from now on, and maybe even audit. I think for medium and larger entities, that would require, obviously more than that, would require really tax planning, tax policies to be set up. maybe some valuation, as we will see later, and certain areas that will need to be addressed prior to the implementation of the corporate income tax. Just in terms of the corporate income tax rate, you know, we know it is 9% on the net profit that exceed 375,000 dirhams a year for the first financial year. However, for up to 375,000 dirhams, it is going to be zero. Up to 375,000, 9% above 375,000. And it's going to be a different rate for large multinational entities, MNEs, that meets specific criteria as per the Pillar 2 of OECD. And what is meant by large multinational entities really is a corporation or a business that obviously operates or have branches or entities in different jurisdictions, different tax jurisdictions. When it comes to OECD, it is I think, or I believe it is the only organization that is really governing the international taxations worldwide. And as we know, the UAE last year became a signer of and joined the OECD as a member. Large refers to entities that are, or groups or multinational entities that are making, in terms of consolidated global revenue, more than 3.15 billion dirhams, which is equivalent to 750 million euro. So for those multinational entities that are, let's say, within UAE and have, subject to Pillar 2 of the OECD, most likely they will have to apply the 9% rate for up to 3.15 billion, and then they will have to apply the OECD rate, which is, as we are aware, is 15% on the profit that is exceeding this 750 million a year as a consolidated number. Just a quick example in terms of how is this calculated. So for example, if we have an entity or a corporation or a business that's subject to corporate income tax, that have a net profit of 400,000 dirhams a year for their first financial tax period, the up to 375,000 dirham, as we said, will be subject to zero tax rate. So it's not that it is not taxable, but it's similar to the zero rated items under the indirect tax or VAT. It is subject to zero rate, which could change in the future, obviously. Now, whatever exceeds, that is exceeding the 375,000, so that will be, in this case, 25,000 dirhams, which is exceeding the 375,000 up to their number or net profit, that will be subject to the 9% rate. So in that case, the tax will be on this business who's making 400,000 dirhams subject to corporate income tax in the UAE of 2,250. So the final amount of the UAE corporate income tax, as we said, there will be within the tax return. So let's say you have your income tax return and you calculated your tax based on your net profit, based on the tax rate. You applied all the deductions, as we will discuss and will be addressed on the regulations. There will be also credit available to businesses to take advantage of, such as foreign taxes paid by foreign branches to different jurisdictions, whether you have a tax treaty with UAE or not, but subject to OECD Pillar 2 regulations. Or if you have, for example, losses carried forward, as will be also defined by the regulations with certain conditions that can be carried forward and then will be netted off against your net, your taxable profit. So in terms of personal tax, as you must have heard and aware, all there won't be income tax on individuals as per the recent regulation that will come in effect in June 1st, 2023. There won't be any taxes on salaries, on individual or personal investments, um, uh, salaries, investment income, interest income, as long as it is under the name of an individual who have no business license, who is not conducting business, that will not be subject to any corporate income tax as an individual personal tax. The business income earned under commercial license, therefore, will be subject to tax. So let's say if you are an individual with a business license and you do have investment, you will be expected to pay tax on your passive income or your individual income. Uh, for the investment in real estate, also this has been addressed by the ministry. It will not be subject to corporate income tax or to the income tax, provided that it is in the capacity of personal investment. It is under the name of individual who does not conduct business or who have no business license. It should be out of scope of the corporate income tax in the UAE. And always they refer to the business license because you might be an individual, have no article of associations or have no corporation, but you might have a business license within free zone jurisdiction or mainland within any Emirates. That will require you or will subject you to the corporate income tax. Uh, Will the income earned by a freelance professional be subject to corporate income tax? Again, it will be considered individual unless this freelancer have a business license, and therefore it will be subject to he or she will be required to file their tax return uh, within UAE for their earned income within UAE. Will income earned by individual from bank deposits, interests be subject to corporate income tax? As we said, no, will not be. The UAE corporate income tax will generally apply on the income earned from activities, as we said before, under a freelance license or corporate income tax payable that exceeds the 375,000 dirhams at the tax rate of 9%. Of course, provided that these individuals are, considered, doing business or having a business license. So based on this, we would, of course, conclude that passive income for businesses would be taxable. However, let's say investment income, valuation income, that usually will come as probably within your profit and loss, within your income, or within your other comprehensive income even. Of course, further details will be addressed within the regulations. However, similar to most of jurisdictions, including Saudi Arabia, it is item, these other comprehensive income, or let's say valuation income or investment income, that is under the name of a business and comes as a passive income or OCI, usually is an item that comes under adjustment or addition to the taxable income within the tax return. But of course, that will be confirmed with the regulations the next few months. As we said, of course, interest on deposit will not be subject to tax based on individual capacity. So there are exemptions when it comes to corporate income tax. They address certain industries. These mainly related to the oil and gas extraction, upstream activities within different emirates, because currently it is being taxed, especially the foreign entities who are operating or operator within the national oil companies within UAE or different emirates at the emirate level and at a percentage of 5%. These will not be subject, will continue to be subject to the special tax rules under each emirate. The dividends and capital gains earned by UAE business, as we have said, from its qualifying shareholders will be exempt from UAE corporate income tax. And what is qualifying shareholding as referred to is the ownership interest. Qualifying shareholding refers to an ownership interest in a UAE or foreign company. So basically, those shareholders that meet certain condition that will be specified within the regulations. So in this case, let's say you have dividends or capital gains earned by the shareholders. This will probably be subject to, when it comes to tax group that we will discuss later or in the following slide, it will be subject usually to elimination between companies or between related parties. When it comes to related parties or intra-group transaction, as we would say, the corporate income tax in UAE will allow the grouping similar to the VAT. You will be able to have tax group for the purpose of corporate income tax. Maybe it's the same group that you have under the VAT currently, or it's going to be with different parameters. I would suspect that one of the items would be control versus just management, as we see now in the VAT regulations, as this will be eliminated, as we said, under the tax group. But we will talk about it under the group section. For the foreign entities, will the foreign companies or individual be subject to UAE corporate income tax? As confirmed in terms of personal capacity as investors, it should not and it will not be subject to corporate income tax. However, of these individuals have a business license, it should be and it will be subject to corporate income tax, and they will be required to file their tax return. Will income earned by a foreign investor be subject to UAE corporate income tax? For example, branches. The foreign corporate income tax paid in the UAE taxable income will be allowed to take tax credit against the UAE. So let's say you have a foreign branch entity in UAE or in a free zone that is conducting business within the mainland and subject to corporate income tax. However, their tax or their earned income or net profit is actually being consolidated in other jurisdiction and end up paying taxes there. The tax that is related or paid to the foreign jurisdiction is subject to credit, as we said before. Of course, the details will be addressed in the regulations. However, what this really means, I suspect, is effectively those entities will probably need to maintain two set of books, some related to, similar to the free zone entities, where the transactions or the business is conducted with a UAE mainland entity. This will make it subject to tax, and therefore you probably will need to maintain tax records for that, maybe separate accounts. That's up to your policies. So in general, corporate income tax are not to be levied on foreign investors, as we said, dividends, income earned, gains, investment, as long as they are not being licensed by any jurisdictions within UAE. When it comes to free zone entities, as we heard from the ministry and confirmed that they will be subject to corporate income tax related to their business, conducting business or transactions with the mainland businesses. They did confirm that they will honor whatever agreements by these certain jurisdictions or free zones or designated zones in terms of free taxations. Some jurisdictions, as you might be aware, they have free taxations for businesses within the corporate income tax, direct taxations within their articles for the next 50 years. we still really don't know how would that work. Again, if let's say a company in Jabal Ali is conducting certain businesses or having transaction with a mainland entity, how would that be accounted for? How would that be determined and then concluded in terms of taxation? But in general, they as they said, it should not be subject to tax except to the extent that is related to conducting business within the mainland UAE. So will a free zone business be required to register to file corporate income tax? Again, that will be further details will come through the regulation, but I suspect that all entities, whether free zone or mainland, that have a business license or incorporated would be required to register for corporate income tax. If you think about it, when it comes to the threshold of 375,000, similar to the VAT, that is conditioning or based on you reaching the 375,000 dirhams. But when it comes to the corporate income tax net profit, it's actually starting from zero. So you might have zero profit or break even, or let's say loss, but that does not mean that you are not subject to corporate income tax. You might have 100,000 dirhams net profit. You will be subject to zero income tax rate. So therefore you will not be paying income tax. However, you still required to register and file your tax return. And I believe the same thing will be applicable to the free zone entities or designated entities, unless they probably have no business at all within the mainland jurisdictions. The corporate income tax treatment that will apply to businesses in free zone will therefore be the same in terms when it comes to registration across all free zones. In terms of industries, industry-wise, as we said first, when it comes to oil and gas, especially the extraction, the upstream operation, these will continue to be subject to the emirate income tax at 5%. However, it's important to note that these are mainly the companies or the multinational oil and gas companies that operate or have, let's say, joint ventures or agreements with the national oil companies, for example, such as ADNOC, maybe other companies within other that is owned by the government, but not really the supplier. So let's say if there is an LLC that is incorporated in any emirate that is a supplier to one of these companies, that does not put this company as out of scope of the corporate income tax because it's not subject to the 5% emirate oil and gas tax. In terms of banking, all banking will be subject to corporate income tax as all other entities. Real estate, it's the same thing. Again, all industries really, no exemption except for the oil and gas. The only exemption that we discussed earlier is if these, especially when it comes to real estate owned by individual that have no business license, regardless of the real estate portfolio or the volume of business they have, as long as it's under his or her personal name, it should not be subject to corporate income tax as confirmed by the ministry. When it comes to tax group, as we said, I guess we went through this already. It is allowed. It will be detailed in the regulations. I think similar to the VAT or the indirect tax, one additional condition probably is to demonstrate control, because most likely it will be based on a consolidated financial statement that will be subject to the corporate income tax when it comes to tax group for the purpose of corporate income tax. So therefore, any group, any tax group, let's say, regardless of the number of entities, will be required to file only one tax return as a combined return based on maybe combined or consolidated financial statements. The financial period is usually going to be 12 months or 1 year, regardless of its start dates or end. It is 12 months period, whether the inception period, the first tax period, or going forward, it's going to be always 12 months period. And this is really similar to many other jurisdictions across the world. The tax return will be filed electronically, most likely under the same portal of the FTA, and probably the same tax registration number for those businesses that are already registered. The UAE businesses or entities subject to corporate income tax will not be required to make advance UAE corporate income tax payment. For example, certain jurisdictions would require that businesses make an estimated tax payment on a quarterly basis or on a monthly basis, depending on your expected net profit or your gross revenue. That is so far is not expected to be required in the UAE. Similar to individual taxations in other jurisdictions, it is only you pay by the due date. If there is any tax due, you will pay by the due date of filing the tax return. And similar to other taxes in the UAE, businesses will be subject to penalties, of course. We'll see the details, but I suspect when it comes to payment and filing tax return, it will probably be similar to what we have currently under the VAT regulations. Tax treatment and policies, this is really important for tax planning. As we said, when it comes to withholding taxes and confirmed by the ministry, there won't be any withholding tax in the UAE as confirmed, but this might change. As they said, this might actually change. So what is withholding tax? Withholding tax, which actually is in effect in many, I have not seen any other corporate income tax jurisdictions, including Saudi Arabia, maybe also Qatar, that is not subject to corporate income tax withholding. So that's probably something that will change soon. But when it comes to corporate income tax, it is the withholding tax that exists in many tax jurisdictions that is typically used in respect of, let's say, unregistered taxpayer or foreign taxpayer. Let's say you have a supplier or a customer that is not within UAE. Before you pay them, you have to withhold, let's say, 9% tax on the invoice amount, or maybe certain amount, and submit this file, pay this on their behalf to the government, and they will have to go and file their tax return. So this will be paid to them once, paid back to them once they get tax, what's called tax clearance certificate. However, I mean, it's a bit complicated when it comes to withholding tax, but it's the good thing, it is not subject to withholding tax in UAE, the corporate income tax. When it comes to tax credit, we talked about the corporate income tax, the foreign corporate income tax that is paid to foreign jurisdiction. That is really, so far, the only credit that is being addressed. However, I expect further details in terms of credit that will come through the regulations. And of course, there will be the credit of carried forward losses in case if there is any losses incurred by the business. Transfer pricing. This is a really very interesting subject. What is transfer pricing? Now, we all know the related party transactions. We all know transactions with directors, shareholders. These are actually considered within the scope of the transfer pricing definitions, which is transaction between related parties, related businesses, related individuals. And interestingly, the UAE regulation will be within the scope of the OECD rules when it comes to the transfer pricing. And the OECD rules basically saying that the transfer pricing is based on, two things. First, arm's length basis, as we all know, it's an accounting concept, is basically on what is currently in the market and the special rules of every separate jurisdiction. So when it comes to transfer pricing, the UAE will not regulate this and will be subject to the OECD, which is a bit complicated area that will definitely need to be addressed. So that is an area of consideration. Any businesses that are conducting, transactions or business with their related party, it is important that you from now understand what the OECD rules when it comes to the transfer pricing. Is the rate or the pricing that you currently have under your agreement acceptable or in line with the OECD regulation? That is definitely an area of considerations, and you don't want to get surprised by, reversing certain, expenses or certain costs because it's not subject to the OECD rules. So I will definitely advise you. It's an area that we will have a separate session hopefully soon about it, just when it comes to the transfer pricing. So as we said, the UAE companies, as per the Ministry of Finance answer, companies undertaking transaction with the related parties will be required to ensure arm's length basis pricing of transactions. And of course, when it comes to arm's length, it's very subjective definition. What would be considered an arm's length? And based on the OECD rules and guidelines, there are certain parameters that you will need to consider. Of course, again, especially for those medium and large businesses who have in particular transactions maybe with related parties outside UAE. In that case, you will be subject to the OECD rules maybe on that specific jurisdictions if it is regulated. For losses, of course, again, it's accounting losses. The corporate income tax will allow prior year losses to reduce your future taxable income as a credit. A loss for corporate income tax purpose would usually or is effectively the total when your total deductions and deductions when it comes to deduction and expenses is a very important item to define and define policies. What are the acceptable deductions as will be regulated that can be claimed, which is greater than your revenue or your taxable income. And therefore you have a losses. Of course, this is expected similar to any other tax jurisdiction to be under the careful review and regulations by the FTA or by the regulator in UAE, because it will basically inform the business what deduction that will be allowed. For example, when it comes to your non-cash expenses, when it comes to your directors or shareholders compensation, especially for sole proprietor or shareholders or businesses that have one shareholder or one owner or establishment, we expect there will be limitations, regulations similar to other jurisdictions, similar to what we see in Saudi Arabia, on the threshold or the limits that will be allowed for businesses to carry in terms of deduction. So it is definitely another area of businesses really to consider when it comes to tax planning. For example, we know in the UAE there tend to be withdrawals by the shareholders. It is known that the withdrawals by the shareholders or distributions of, let's say, retained earnings or profit is not tax deductible item, versus salaries should be usually a tax deductible item, but of course subject to certain rules and limitation when it comes to owners or related parties or directors' compensations, including, of course, board of directors remuneration as a tax expense or not. It is an area that needs an assessment by businesses. You need to quantify really these transactions, look at the accounting policies that you have now, and how would this be translated into a tax policy. Businesses would be expected to have a tax policies that might be different than your accounting policies, that might be different than your IFRSs. And that might result, similar to many other jurisdictions, into maintaining or having two sets of books, one for under tax rules or tax policies, and one under maybe IFRSs. But it is the time that I would encourage all businesses, all entities to assess from now. Those businesses who are waiting for the regulations really to come, if you go back to our experience with VAT, when the regulations came out in November and December 2017, there was really not much time for any tax planning, and that was only indirect tax, which, as we said earlier, is not even an expense on your company. When it comes to your corporate income tax, of course, it is an expense. So the purpose of any entity is obviously to reduce their taxable income, to reduce their tax based on the regulation, based on the rules allowed by implementing or adopting certain tax policies as allowed by the regulations. Excess tax losses, therefore, will be carried forward. We don't know for how many years. We don't know which tax losses they talking about. Most likely, it's going to be the tax losses that will incur after the implementation of or after the corporate income tax law become effective, and therefore it's from the starting from the tax periods where you will be subject to the corporate income tax, as we said. When will your corporate income tax or your tax year will start? And of course, for tax groups, as a one tax return, it is understood that maybe one company profit will be offset against maybe other company losses in the corporate income tax return. So I think when it comes to area of considerations, I probably touched on many of these. However, as I said, the objective of any business when it comes to corporate income tax, obviously, as an expense, as a cash flow, is to pay the minimum in accordance with the law and regulations. And again, those businesses who think that the corporate income tax is effectively a specific rate that will be applicable on corporate income tax, based on my experience working on different jurisdictions, these businesses unfortunately will end up paying extra, will end up overpaying their taxes because of two reasons. Number one, lack of adopting appropriate tax policies that is allowed to you, for example, in the area of depreciation, in the area of non-cash expenses, amortizations, in the areas of related parties, transaction, transfer pricing, in the areas of valuation of your assets and liabilities. For those businesses that have no accounting records or have no financial statement, and these are mainly that we see in small businesses, will definitely need to consider maintaining appropriate accounting records, and again probably conducting an audit. Most likely the accounting profit that is referred to under the regulations or will be referred to is going, there need to be a verification of this number, and the verification of this number most likely, as we see in many other or most of other jurisdictions, would be based on your audited accounts. An audited accounts based on your accounting policies and the IFRSs. Those businesses who have no appropriate records, or the FTA might consider that they don't have sufficient records, will be subject to assessment. Assessment, of course, will always be on the higher range. So they will, that's another way of end up paying more than what you should be paying uh, if you maintain really appropriate accounting records. When it comes to tax accounting policies for tax reporting, there are many areas that businesses will need to look into the tax policies. As I said, we will discuss this in further details in other following seminars or webinars. But the tax and accounting policies should always consistently be documented and implemented. And I would expect that the implementation date should be really effective before June 1st, 2023. In terms of amendment, in terms of valuations, in terms of deductions, of course, we talked about non-cash expenses that will be regulated, such as your depreciations. We know, many businesses, especially in UAE, they tend to depreciate their assets within 3 to 5 years quickly, and then you will have these fully depreciated assets, that have no value in your books. I expect that the jurisdictions the regulation will allow a certain valuation for these assets, fully depreciated assets, for a certain up to certain period based on certain standards and rules when it comes to valuation, and then recognizing these assets and then applying the depreciation rules, for example, on them. So if you have a fully depreciated items in your business, in your company, that is definitely something that you will need to consider. Otherwise, you will be missing some deductions or depreciation. We talked about related parties compensations or management compensation and transactions, whether subject to transfer pricing or certain regulations. You will definitely need to consider taking these as deduction instead of withdrawals, instead of distribution versus expenses. Of course, when it comes to personal entertainment expenses, this will be regulated similar to, even you have it under the indirect tax or VAT being regulated or limited. There will be limitation on these, and therefore businesses would need to take this into consideration. I hope we are right on time. Last but not least, how we can help. We do what's called the business tax readiness or roadmap for corporate income tax implementation. And that really starts with the assessment of tax readiness and how is your business, your system, your policies and procedures, your current transactions are in line with the best practice when it comes to tax adoptions or corporate income tax or direct tax application. And then we move to the implementations and controls, and that will ensure that you, of course, you have the controls, and you have the system, you have the capabilities, you have the resources, you have the human capital, more importantly, that is aware of the regulations, aware of the tax policies, aware of the valuation areas that will give you the best tax position, and of course compliance. Once this is established, the tax planning stage will really start in terms of your policies and procedures, in terms of your agreements, let's say in terms of your maybe joint ventures, in terms of your accounting policies versus tax policies, and how would these be adopted, in particular when it comes to your deduction and expenses. How would you elect, maybe prior to the regulation date, to take in policies that will allow you for the highest rate of deductions, whether related to cash or non-cash item or expenses. And then that will take us to the last stage, which is the compliance and optimizations. And really, it's more of risk assessment once the pyramid is being established when it comes to the tax readiness, the implementation and controls, and you have done your tax planning, establish your policies and procedures, ERP readiness. Then we'll move to the optimizations and compliance, and that really to prevent the risk of non-compliance um, with the tax regulations, as I expect probably, will be getting more complicated, will be getting more regulated as we move forward in terms of regulations. So that's it. I hope you have we have achieved the objectives. You learn about the corporate income tax. Again, as I said, we will be sharing the recording and the material of this webinar, and of course we'll be glad to answer any question. Uh, and I'm not sure if there are any questions posted. Zuhaib, is there any common question, one or two questions we can answer before we conclude?
Actually, there are no questions posted from any of the joiners.
Okay, thank you all very much for your attendance. I really appreciate it, and I hope we will see you soon in other webinars. Thank you.